Same night, same earnings session. Two of the best companies on the planet report results. One stock explodes 14% higher, the other plunges 9%. Here is the crazy part: both beat Wall Street's earnings expectations. So, why did investors celebrate one and punish the other? Let's break it down. Apple reported another massive quarter. iPhone sales jumped 22%. Revenue beat estimates. Profits came in stronger than expected. On paper, it looked like exactly what investors wanted. Yet, the stock fell sharply. Now look at Amazon. AWS, its cloud business, grew 37% year over year, its fastest growth in years. Management also announced plans to invest around 220 billion in 2026 to expand AI infrastructure. Instead of worrying about the massive spending, investors cheered it. The stock surged. So, what explains the difference? It comes down to one word: expectations. The market doesn't reward companies for reporting a great quarter. It rewards companies that convince investors the next few quarters will be even better. Apple delivered strong results, but management also warned that growth is expected to slow because supply constraints for advanced chips and memory could limit future demand. That changed the entire conversation. Investors immediately shifted their attention from what Apple earned this quarter to what it might earn next quarter. And that is all it took for billions of dollars in market value to disappear. Amazon told the opposite story. Strong cloud growth suggested that its AI investments are already translating into higher demand. Even more importantly, management showed confidence by increasing capital spending, and investors viewed that spending as fuel for future growth rather than a cost. This isn't just about Apple and Amazon. We are seeing the same pattern across the technology sector. Companies demonstrating that AI is driving revenue growth, stronger margins, or accelerating cloud demand are being rewarded. Companies creating uncertainty around future growth, even after reporting solid earnings, are facing much tougher reactions. That is because the market has become far more selective. Big tech is no longer moving as one group. Each company is being judged on its execution, its own guidance, and its own ability to turn AI investments into profitable growth. Here is the lesson every investor should remember. Earnings tells you where a company has been. Guidance tells you where it is going. And in the stock market, tomorrow almost always matters more than yesterday. If you like this video, do not forget to subscribe, comment, and share. Free equity analysis course link in the description. Thank you.